Hey everyone and welcome. Today we're diving into a core concept in personal finance: assets. You hear this word thrown around a lot in investing, in financial planning, even in everyday conversations about money. But what exactly is an asset? And why should you, as an American navigating your financial life, really understand this idea? Simply put, an asset is something you own that has economic value and is expected to provide future benefit. That future benefit is the key. It's not just having something, it's that something having the potential to generate money for you. Think of it as something that puts money into your pocket rather than taking it out. Now let's break that down with some relatable examples, because economic value can sound a bit abstract. The most common asset people think of is probably real estate. If you own a house, that's an asset, not just because it provides shelter, but because its value can increase over time and you can potentially rent it out for income. That's future benefit right there. But real estate isn't the only asset. Let's talk about stocks. When you buy shares of a company, you're buying a small piece of ownership. If the company does well, the value of your shares increases. You can also receive dividends, which are like little cash payments the company makes to shareholders. Again, future benefit. Bonds are another type of asset. When you buy a bond, you're essentially lending money to a government or corporation. In return, they promise to pay you back with interest. That interest is your future benefit. Now let's think about something a little smaller scale: a savings account. While the returns aren't huge, the money in your savings account is still an asset. It's earning interest, even if it's a small amount, and you can access it when you need it. Even personal property can be an asset, though often depreciating ones. Think about a car you own outright, meaning you don't have a loan on it. It has value, you can sell it, but it's important to remember most cars lose value over time. That makes it a different kind of asset than, say, a piece of art that might increase in value. So why is understanding assets so important for Americans? Well, building wealth isn't just about earning money, it's about what you do with it. If you spend every dollar you earn, you're not building assets. But if you consistently invest in assets, stocks, bonds, real estate, even high-yield savings accounts, you're creating a financial foundation for the future. Let's compare two scenarios. Imagine Sarah and David. Both earn $60,000 a year. Sarah spends everything she earns on lifestyle expenses, dining out, clothes, entertainment. David, on the other hand, lives modestly and invests $500 a month in a diversified stock portfolio. Over 30 years, even with modest returns, David's investments could grow significantly, potentially providing him with a substantial retirement income. Sarah, on the other hand, will likely have very little saved for retirement. The difference: David focused on building assets. It's not about having a lot of money to start with. It's about consistently allocating your resources to things that have the potential to grow in value. Even small, consistent investments can make a huge difference over time. Now let's talk about the difference between assets and liabilities. This is crucial. A liability is something you owe money on: a mortgage, a car loan, credit card debt. Liabilities take money out of your pocket. Assets, as we've discussed, put money in. Your net worth, a key measure of your financial health, is simply the difference between your assets and your liabilities. The goal is to have more assets than liabilities and to grow that difference over time. There are different types of assets too. We've touched on tangible assets like real estate and personal property, but there are also intangible assets. Intangible assets are things like intellectual property, patents, copyrights, trademarks, or even your skills and education, which can increase your earning potential. Investing in assets isn't without risk, of course. The value of assets can fluctuate and you could lose money. That's why it's important to diversify your investments. Don't put all your eggs in one basket. Spread your money across different types of assets to reduce your overall risk. And consider your time horizon, how long you have to invest. If you're saving for retirement, you can generally afford to take on more risk than if you're saving for a down payment on a house next year. To quickly recap, an asset is something you own with economic value that's expected to provide future benefit. Understanding the difference between assets and liabilities is critical to building wealth. Focus on acquiring assets, diversifying your investments, and considering your time horizon. It's about making your money work for you, rather than the other way around. Building a solid base of assets is a cornerstone of financial security, allowing you to achieve your financial goals and live a more comfortable life. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.